Okay, we move to the last part of this chapter, which is called interest rate swaps. Let's understand this interest rate swap concept and then we do questions around it. Now, first let's understand there are guys, you do discussion later, please. There are two types of loans in a practical world. One is a fixed rate and second is a floating rate. Now, normally, I will prefer to take a fixed loan if I feel interest rates will go up in the market. This is more only from a loan point of view, interest rate swap. Investment, very rarely you will see an IRS kind of a question. It's only from a loan point of view. So, what happened here is I wanted to take a loan. I went to the bank. Bank told me a fixed rate as well as a floating rate. What is fixed rate? The rate will not change. What is floating rate? The rate will undergo changes. If interest rates are likely to go up, interest rates are likely to go up, I want to pay a fixed rate and not the higher rate. I want to pay a fixed rate and not the higher rate. And if interest rates are likely to go down, I want to pay the lower floating rate. I want to pay the lower floating rate and not the higher fixed rate, not the higher fixed rate. So fixed rate is preferred if interest rates are likely to increase. Technical name is hardening of interest rate. Hardening means interest rates are likely to go up, and softening of interest rate means interest rates are likely to go down. Hardening and softening of interest rate. So depending on what is going to happen to interest rate, you have two options: either to go for a fixed loan or to go for a floating loan. In the India's context, majorly banks give only floating loan, but if I have a choice, these two options are there. Now, where does IRS come into picture? Let's understand. And IRS, what is IRS? Interest rate swap. Swap means it will help you in converting or swapping a fixed loan into a floating loan. I went to ICICI Bank. I wanted a floating loan. ICICI Bank is adamant saying that they'll give only a fixed loan. So I went ahead and took a fixed loan, but my interest is in floating loan. So take a fixed loan from ICICI, do certain transactions by which you will swap this fixed into floating, by which you will swap this fixed into floating. Or you took a floating loan and you do certain transactions by which this becomes a fixed. This is one simple example. Second is, it is also an example by which, or it is also a tool by which I can reduce my interest outflow. Reduce my interest outflow. Let's understand. There are two borrowers, A limited and B limited. Both get quote of fixed rate and floating rate from bank. Both get both the quotes, fixed rate as well as floating rates. I'll parallelly read the example. Madagascar Limited is an Indian company. They are in the process of raising a US dollar loan and are negotiating rates with a foreign bank. The company has been offered a fixed rate of 8% with a proviso that if they opt for a floating rate, the interest rate will be linked to a benchmark rate of 60 basis point over 10-year US Treasury bill rate, over 10-year US Treasury bill rate. That is, you can go for fixed loan 8%, floating loan treasury bill rate plus 60 basis point, treasury bill rate plus 60 basis point. Clear? Now let's write this. Let's write the information. Particulars. Question 17. Particulars. There will always be two borrowers in the question. Without two borrowers, you cannot do the problem. Particulars. Madagascar Limited, M Limited, and there will be another company in the question, M Limited, and the other company in the question is S Limited, Syndicate India Limited, S Limited, fixed rate, floating rate. Two companies have to be there and both have to give me this fixed rate and floating rate. Fixed rate and floating rate. I'll read again. Madagascar Limited is an Indian company. They are in the process of raising a US dollar loan, negotiating the rates with a foreign bank. The company has been offered a fixed rate of 8%. So fixed rate 8%. 8%. What is floating rate is, we saw a lot of problem, LIBOR plus 0.5 or MCLR plus 0.2 or any benchmark will be there plus something, rarely minus also can happen, but normally plus. And if I go for US treasury bill, that is floating rate, T plus zero point 0.6, T plus 0.6. And what is T? 10-year treasury bill rate, which keeps changing. It will keep changing. So floating is T plus 0.6%. T plus 0.6%. Similar numbers I need for two companies. One company alone, swap will not happen. Two companies, you have to get the data. Syndicate India has been offered. Read and tell me what are the rates for Syndicate India. In the last para, it is last line, it is there. Fixed some rate, floating some rate. 9.2 is the fixed rate. Floating rate T plus 1.2%. T plus 1.2%. T plus 1.2%. Clear? So fixed 8 and 9.2, floating T plus 0.6 and T plus 1.2. These are the rates available in the market. Available in the market, 8 and 9.2, T plus 0.6, T plus 1.2. I went to the bank, asked them, they gave me this rates. Now let's go back to the steps. Compute total interest of two combination. What is two combination? First company fixed, second company floating, or first company floating, second company fixed. Compute total interest of two combination, any order. One combination is company A fixed, company B floating. Second combination is company B fixed, so company A floating, company. So you have to find two combination. Let's go back to the same thing. Combination 1. Combination 1, M limited fixed, S limited floating. Please add the numbers. Just put a total 8 plus T plus 1.2. Just add the numbers. M will go for fixed, S will go for floating. M is 8% plus T plus 1.2%. 8 plus T plus 1.2%. 8 plus T plus 1.2%. Put together we get T plus 9.2%. Now, in an IRS, as we proceed, we'll understand one company will need fixed, another company will need floating. Assuming both need fixed, I cannot do IRS. Assume both need floating, I cannot do IRS. When you have to do one company with another company combination, else I do and bank has to be the counterparty and they have to take care. If bank is not ready to be the counterparty for the transaction, then I need one guy paying fixed, another guy paying floating, or the first guy paying floating, second guy paying fixed. Here, first combination, this next combination 2, M limited floating, S limited fixed, T plus 0.6%, 9.2%, put together T plus 9.8%. To put it simply, I have two combination. One is an yellow combination and second is a green combination. One of them will be better. There is an yellow combination and there is a green combination, one of them is going to be better. Which one is better here? T plus 9.2%. Why this is better? Assume these are not two separate company. Division A of my company, division B of my company only. One guy wants fixed, another guy wants floating. So I tell them, please M division take fixed and S division takes floating. If the company also wants exactly the same, IRS again is not needed. IRS again is not needed. What is the ideal combination here? Combination 1. That is, M should go ahead and take a fixed loan. S should go ahead and take a floating loan. But if they are adamant saying that M wants to take floating, S wants to take fixed, then some swap structuring would be needed. Then only a swap comes into picture. As of now, which is better is right below this. Ideal combination. Ideal combination. Combination 1. What is ideal? One which has lower interest. Ideal combination is combination 1 in bracket lower interest cost. Lower interest cost. So I explained it and they said I have told them please go with combination 1. We'll read the question later to understand what combination they want and all. But I explained them combination 1 is good. Find ideal combination, one which has lower total interest cost. Ideal combination is best. However, companies want other combination. Companies want other combination. Hence, we use IRS in this case. If companies want ideal combination, no scope for IRS. What is IRS? You'll understand as we proceed. Why, if they want ideal, no scope for IRS also, you'll understand. So in this question, let's read now and let's understand what M wants and what S wants. What rate of interest M wants? Read somewhere, they would have given M wants fixed loan or floating loan. M would want fixed loan or floating loan. Somewhere they would have given in the question. M believe that interest rates will fall. This itself is sufficient. If interest rates are fall, they want what? Flexible mechanism. M wants floating. S they have given anything? S they have given anything? I think nothing is mentioned in the question about S. I go ahead and assume S wants the other one. M wants floating, S wants fixed. If M also wants floating, no swap. Floating, floating, no swap. Fixed, fixed, no swap. Ideal combination met, no swap. Only one possibility when they are in the non-ideal combination. Non-ideal combination. So whether it is non-ideal or not, I don't know. As of now, M wants floating. Then right, required combination. M limited wants floating equal to S limited wants fixed. This is not given in the line question, but I assume that way. S limited wants fixed. M wants floating. S wants fixed. Is this combination 1 they want or combination 2 they want? 2. But ideal is combination 1. They want combination 2, but ideal is combination 1. I explained them that which is better, but they are adamant saying that they want only combination 2. They want only combination 2. In this case, IRS will come into picture. One exam question came where ideal and required met. No steps after that. No steps after that, because you will say scope for IRS does not exist. Scope for interest rate swap does not even exist. Does not even exist because both were matching. Both were matching. Clear? Any doubts in this? So S limited wants fixed. Now right, required combination, combination 2, ideal combination, combination 1, scope for IRS exist. Scope for IRS exist. scope for interest rate swap exists. Clear? Now, what will IRS do? It will also indirectly help me in saving the interest cost. How does it save? And all will understand. Scope for IRS exists. Any doubts till this? Now I have to do swap structuring. I have to structure the swap. What is structuring the swap is, I will have to structure in such a manner that I will get my, so what does a swap do is, I will tell them to borrow at ideal combination and use a swap process to convert it into the required combination. I will borrow it at the ideal combination, use a process of swapping and convert it into the required combination. Then you may ask, I could have directly done required combination. There will be some benefit in this process. What is the benefit? How it is calculated? Let's understand this. Now, swap structuring. Benefit of swap is difference in total interest of combination 1 and combination 2. Formula is higher interest minus lower interest. Higher interest minus no combo 2 minus combo 1 or combo 1 minus combo 2. Next line, benefit of swap. Benefit of swap. Tell me the difference in interest between total interest between combo 1 and combo 2. Difference in total interest. TT will get cancelled. 9.2, 9.8. So benefit of swap 0.6%. 0.6%. Now this benefit will be split between the two parties. The benefit will, how the benefit come and all, we'll understand as we proceed. There's going to be a benefit of how much? 0.6%. This benefit split of swap gain in specific ratio between company A and company B. If problem is silent, split it equally. If I read this question, it says the gain is to be split part 1 equally, part 2 3 is to 1, and part 3 there is some intermediary, he charges something. We'll understand as we proceed. So it has to be split equally. Now 0.6 split it into 2. M limited 0.3%, S limited 0.3%. Point 3 and 0.3. Clear? Next, effective borrowing rate. Effective borrowing rate, particulars, M limited, S limited. M limited and S limited. I'll explain this again once I'm done with the one discussion fully. M limited and S limited. Original planned borrowing rate. Original planned borrowing rate. Original planned borrowing rate. Now let's understand what is original planned borrowing rate is. M wanted to borrow at what rate? M, participate guys, you'll have to participate. M wanted to borrow at floating rate or fixed rate? Floating rate, right? For M, write T plus 0.6 then. T plus 0.6. M wanted to borrow at floating rate. T plus 0.6. Original plan was to borrow at floating rate. S limited, we said original plan was to borrow at fixed rate. We took it at one floating and one fixed. One floating and one fixed. So S wanted to borrow at 9.2. S wanted to borrow at 9.2. Less share of swap gain. Share of swap gain. Effective borrowing rate. Share of swap gain. Effective borrowing rate. Share of swap gain. Effective borrowing rate. Gain is 0.3%. Subtract 0.3 for both of them. Subtract 0.3 for both of them. Subtract 0.3 for both of them. And effective borrowing rate will be T plus 0.3, 8.9%. I'll explain again one more time. I go back to the original information. M had 8 and 9.2, T plus 0.6 and T plus 1.2. I did calculation. I found yellow combination to be the better one. Company is adamant saying that they want green combination. If that happens, IRS comes into picture. So you do two combination, one yellow, one green. Which is better? You check. You check the better one is yellow combination. Company is saying we want the green combination, which means M wanted T plus zero point 0.6, S wanted 9.2. I told them I will do something and reduce your cost. Don't get it at T plus zero point 0.6, don't get it as 9.2. How much I will save? Difference in total interest of the two combination. How much is the difference? 0.6. This gain will be split between the two party. In what ratio? Problem will give. If not given, equal split. 0.3 goes to the first party, 0.3 goes to the second party. You are still adamant saying that you want green combination. I say yes, we will give you green combination and we will also reduce your interest cost. Will also reduce your interest cost. T plus zero point 0.6 will go down to what? T plus 0.3. 9.2 will go down to what? 8.9. How does it go down is what we have to see now. Any doubts till this? I'll wait for 2 minutes, go through whatever we have done. 2 minutes. Okay. At this stage now I have told that we will have a saving and all, but will it really happen or not? I have to prove it. Some question will ask only for effective borrowing rate, problem ends here. Some question will ask for structuring. Next, structuring of swap. Structuring of swap, very simple approach. Particulars and two companies. Particulars and two companies. Or particulars in one company. Yes, we will do it separately because some students get confused. Doing together is also possible, but I'll do it separately. First, let me close M. Maybe you can have another column called S, but M, let's first close M. Let's close M. Another column you can have called as S, where something else will happen. Borrow from bank as per ideal combination. Please check the ideal combination and tell me in that M will borrow at what rate? 8%. Do it. Borrow from bank as per ideal combination 8%. When this happened, M got irritated because M wanted a floating. M wanted a floating. I told them, don't worry. I will do something by which this fixed will become floating. This fixed will become floating. So they borrowed from bank as per what? Ideal combination. The other company also has to do as per the ideal combination only. Next, they will receive from S Limited. Receive from S Limited. In bracket, receive what was paid to bank. Receive what was paid to bank. Receive what was paid to bank. Receipt I'm putting in bracket, payment I'm putting as outflow. Okay. Receive what was paid to bank. Why we receive and all? Let me complete it fully, then you'll understand. Now net this 8 and 8 will get cancelled. 8 and 8 will get cancelled. Receive what was paid to bank. Pay to S Limited. Pay to S Limited in bracket our effective borrowing rate. Pay to S Limited our effective borrowing rate. Pay to S Limited our effective borrowing rate. We calculated the effective borrowing rate. Tell me what is the effective borrowing rate of this company? T plus 0.3%. Finally, effective borrowing rate 1 and 2 got cancelled. 3 obviously will be our effective borrowing rate. 3 will be our effective borrowing rate. To put it simply, I will give something to S. What a swap is, I give something, take something back. What will I give? You are S limited, I am M limited. I will give you T plus 0.3. You have to give me 8% first year. So again, I'll give you T plus 0.3. You have to give me 8%. Again, I'll give you T plus 0.3. You have to give me 8%. This process will continue. Clear? Next, okay, do it next to column, separate table itself, particulars and S limited. I can do it together also, but some of you will get confused. Particulars and S limited. Later question, we will do it in a single table. S limited. S limited. Borrow from bank as per ideal combination. Borrow from bank as per ideal. Once I am done with both, I'll be able to explain the concept again. Borrow from bank as per ideal combination. Look at your ideal combination. Tell me S limited will borrow at what rate? T plus 1 point. Okay. Receive from S limited. So receive from M limited. Receive from M limited. Now listen, what will you receive is not saying that like the earlier one. First company we are done. Receive from M limited is this because they are going to pay T plus 0.3. They are going to pay T plus 0.3. I've already done the structuring. Copy the same number because this only I can receive. They are going to pay me T plus 0.3. I will receive whatever they are paying. I will receive whatever they are paying. Structuring is already over. We are just writing the other side party. First, this is the real structuring. This is already done. We are just going to copy paste number. So I am going to receive T plus 0.3, write it in bracket because receipt for me. T plus 0.3. T plus 0.3. Pay to M limited. Again copy paste. Pay to M limited. Pay to M limited. How much are we paying? 8%. Can you put a total of this now? Effective borrowing rate. Put a total first. T and T will get cancelled. Net, what is the number? 8 plus 1.2 minus 0.3. 8 plus 1.2 minus 0.3. Net number is 8.9%. 8 plus 1.2 minus 0.3. 8 plus 1.2 minus 0.3. Net number is 8.9%. Now, you see here, effective borrowing rate was 8.9. Effective borrowing rate was 8.9. Now, I'll explain what we have done here is, I tell the companies, you please follow ideal combination. They are not ready to listen to me. I still tell them, go ahead, follow ideal combination. I will do a process of swap. In the process of swap, M's fixed rate will become to the required floating rate, will become to the required floating rate. Yes, floating rate will become the required fixed rate, will become the required. What does a swap do is it converts a fixed into floating, floating into fixed. It converts a fixed into floating, floating into fixed. So this is what we were trying to do here. What we have tried doing here is, if you look at here, I borrow. If I prepare a balance sheet, I borrowed 8%. This is liability and I receive 8%. So there is an asset technically. There's an asset at the rate of 8%. One loan at 8% and one deposit at 8% indirectly because one is receipt, one is payment. Both will knock off each other and in the end I'm left with T plus 0.3. I'm left with T plus 0.3. I'll repeat the explanation again. What we do is first company, take company 1, 4 simple step. Borrow as per ideal combination. Whatever rate you pay, receive from the second company. Receive from the second company and pay your effective borrowing rate. Pay your effective borrowing rate. What do you do for the second company? Balancing figures. Ultimately, it has to match 8.9. Ultimately, it has to match 8.9. Can I start with company 2 and company 1 balancing figure? Yes, you can do. Which the structuring would be slightly different. The structuring would be slightly different. You can do company 1 to company 2 or company 2 to company 1. Structuring could be slightly different. Here, now right, net. We are swapping 8% fixed rate with floating rate of T plus zero point 0.3. T plus zero point 0.3 with floating rate of T plus zero point 0.3. I can simplify this further also. T plus zero point 0.3 is equal to 8. Zero point 0.3 goes to the other side. T plus zero point 0.3 is equal to 8. T plus zero point 0.3 is equal to 8. Then right below. Net, our final answer. T plus zero point 0.3 is equal to 8%. T equal to 7.7%. T equal to 7.7%. T equal to 7.7%. T equal to 7.7%. Indirectly, the swap will not happen at T plus zero point 0.3 equal to 8. Why should I add 0.3 in the first number? I will pay T, other party will pay me 7.7. 0.3 is knocked off. 0.3 is knocked off. Net swap is T is equal to 7.7. T is equal to 7.7. Now listen. First company wanted T plus zero point 0.6. I tell them borrow at 8. I tell them borrow at 8. Second company wanted 9.2. I tell them borrow at T plus 1.2. In the process, 60 basis point will be saved. How are we dividing the 60? 30 and 30. We have divided this as 30 and 30. Now, my effective borrowing rate is whatever combination you wanted, minus the share of swap gain. How do I do structuring? First company, any company you can take. Borrow as per ideal rate, receive from the other company what you paid, pay your effective rate to the other company, final effective rate. Second company, borrow from bank as per ideal combination. 2 and 3 is balancing figure from the other company. Balancing figure from the other company, and you will get your effective borrowing rate, which has to match what you calculate earlier. Any doubts on this? Let's do the structuring again, where the ratio now is 3 is to 1. The ratio now is 3 is to 1, and we will start with company 2 first and company 1 later. Any combination, you doesn't really matter. If you see in the answer, I have written T and 7.7. I have not even written T plus 0.3 and 8. Final answer will match. Whichever way you structure as T and 7.7 or T plus 0.3 and 8. Final answer will match. That is, I said T plus 0.3 is equal to 8. T is equal to 7.7. Directly writing T equal to 7.7, some students found it difficult to understand. So, steps are very simple. Borrow as per ideal, receive what was paid, pay what you want to pay as effective rate, and final effective rate. Clear? Next, let's do the second scenario. Swap gain is 0.6. Share of M, how much M will get in this? 0.45. Share of S, 0.15. 0.45 and 0.15. 0.45 and 0.15. Effective borrowing rate of M limited equal to what was the originally planned rate for M limited? T plus 0.6. In this, I will save 0.45. We did this as a table in the earlier scenario. I wanted to start with explaining in detail. Now we have understood the concept. T plus 0.6 minus 0.45. We get T plus 0.15%. Effective borrowing rate of S Limited. S wanted to borrow at what rate? 9.2% minus 0.15, 9.05. Ultimately this has to see, ultimately what you want I'm giving you. You wanted a one combination which I ultimately give it to you, but I tell you to do it in a roundabout manner rather than directly doing it. I say you do 2 3 steps and save some money also, save some money also, but you have to do 2 3 extra step. Directly I don't want you to do it, I want you to do it in a roundabout manner, in a roundabout manner. Any doubts on this? Now let's do structuring of S first and then we do M. Doesn't really matter. Net net that T is equal to something will match. T is equal to some number will match. Structuring of S Limited. Particulars on S Limited. First line remains same. Borrow from bank as per ideal combination. Borrow from bank as per ideal combination. As per ideal combination. T plus 1.2. Now again I'm repeating, you can start structuring for company 1, you can start structuring for company 2, that's your wish. Now write receive from M Limited in bracket what was paid to bank. What was paid to bank. What was paid. I'm doing structuring for company 2 first and company 1 is balancing figure. You can do anyways, okay? You can do company 1 first, company 2 balancing figure, or company 2 first, company 1 balancing figure. That's your wish. I receive back this. Whatever I paid, I receive back. I receive back T plus 1.2. In the earlier structuring, I was receiving T plus 0.3. Here I am receiving T plus 1.2. Pay our effective borrowing rate to M Limited. Pay our effective borrowing rate to M Limited. What is our effective borrowing rate? 9.05. And final answer, effective borrowing rate 9.05. 9.05. Now I'll do structuring of the first company, which is balancing figure. First company is only balancing figure. 9.05%. Any doubts till this? Clear? 9.05%. Can you proceed? Any doubts on 9.05%? Done? Can we? Any doubts? Clear? Okay. I've done the structuring. Everything got over. Now, let's do it for the other company. Let's do it for the other company. Structuring of M Limited. I can do it in single table also, but sometimes you may find it little confusing. So I do it as separate table. Printed answer will have single table. Borrow from bank as per ideal combination. Borrow from bank as per ideal combination. What's the borrowing rate from bank as per ideal combination? 8%. Receive from M Limited. So receive from S Limited. Copy paste from the earlier number. Receive from S Limited. What are we going to receive? 9 point. This is our inflow. 9.05% is our inflow. 9.05% is our inflow. So net net I have an inflow of 1.05 as of now. Inflow, no outflow here as of now. Net net. Pay to S Limited. Copy paste. T plus 1.2. Put a total of this. T plus 1.2. T plus 1.2. If you put a total, you will get the effective borrowing rate which we have written. It will be here T plus 0.15%. T plus 0.15%. If you put a total 8, 9.05, 1.05 saving is there. From 1.2, I remove that 1.05 saving. T plus 0.15. Very simple structuring. Very simple structuring. Whatever was paid there, please copy paste here. Can I start for first company and do second company? Do it. Second company and first company? Do it. Whichever way you are comfortable, you do it. Any doubts here? Now in this process, right, net swap T plus 1.2 is swapped with 9.05. T plus 1.2 is swapped with 9.05. T is equal to T is equal to T is equal to what was the number you get? 7 point. So in this question, T is swapped with 7.85. T is swapped with 7.85. This is in the printed material. You may see a 7.85 as the answer. Net net, this is what will happen. Nobody will pay T plus 1.2 and receive 9.05. 1.2 is knocked off. Net net. So in this table, no, it will not be 8, 9.05 T. Or if you see this table, it will be T plus 1.2 in bracket only T. In bracket only T. Next line will be 7.85 and T would get constant. 7.85 plus 1.2, 9.05 you will get. So you can do swapping in the way any way you want. Net answer is T is equal to 7.85. One guy will pay fixed rate, another guy will pay floating rate. What fixed I will pay? 7.85. I'll end up paying 7.85. And what will be the floating rate? Floating rate will be only treasury bill. Why should I add 1% and add here? We will knock off the amount and write the net amount. Any doubts here? Any doubts here? Clear? Now comes the another variant. Another variant is, so if you see here in the answer, T and 7.85. T and 7.85. Net net final answer is going to remain same whichever way you structure. Whichever way you do the structuring, final answer will remain same. Final answer is effective borrowing rate. Final answer is effective borrowing rate. What does an IRS do? I force you to follow the ideal combination and use the process of IRS and save money for you. Use the process of IRS and save money. Now, third scenario, swap banker charges 0.1% and benefits are shared equally. Benefits are shared equally. This structuring is the easiest of the lot when there is an intermediary. Why intermediary is needed is, I may not find, for example, M Limited cannot search and find there is a S Limited like this. They want one loan, I want one loan, my rate is so much, their rate is so much, and then do a swap and all. Practically very difficult. So normally what will happen is, you will go to ICICI and tell them that you want this. ICICI will have 1,000 other customer where they will have some customer who wanted an opposite number, and without telling to the two companies, ICICI will tell, yes, I will do a swap for you. So they will sit in between, they will receive something, pay something, again receive something and pay something from the other company and earn 0.1%. Earn 0.1%. This 0.1% could be earned from both the companies or together 0.1. I don't know. That is assumption. That is assumption. I'm charging how much? 0.1%. I'll sit in between, receive from you, pay you something, receive from you, pay you. What is swap? Receive and pay, receive and pay. But you will not do, M will not do with S, S will not do with M. Swap intermediary will sit in between, receive something, pay something, receive something, pay something. I'll sit in between, do these transactions. When I do this transaction, I will earn 0.1 together, or zero point 0.1 from first party, 0.1 from second party. I assume 0.1 is the single gain. Single gain. If 0.1% is single gain. Now, right, swap gain, swap gain, swap gain 0.6%, split into 3. Intermediary will take away 0.1%. Intermediary will take away 0.1%. Leftover 0.5. Leftover 0.5. And after intermediary takes over, balance is shared equally. So S will take 0.25, M will take, sorry, M will take 0.25, and S will also take 0.25. 0.1, 0.25, 0.25, 0.1, 0.25, 0.25. First company will take 0.1, second company will take 0.25, third, that is intermediary, will take 0.1, and others will take 0.25 and 0.25. Any doubts on this? Then now, right, effective borrowing rate. Effective borrowing rate is equal to original planned rate minus share of swap gain. Original planned rate minus share of swap gain. M Limited, what was the original plan? Sorry? T plus 0.6. In this, I will save 0.25%. Effectively, you will get T plus 0.35. I'll save 0.25. T plus 0.6, save 0.25. Save 0.25. Effectively, you will get T plus 0.35%. S Limited, 9 point, save 0.25. 8.95%. Save 0.25, 8.95%. Now let's see how structuring is done. Structuring is very, very simple here. Any company you can take, in fact, both we can do it together also. Particulars S and M. Particulars S and M. Four lines are needed. First line, borrow from bank. Last line, effective borrowing rate. In between two lines, balancing figures. With intermediary, it is very easy. Borrow from bank as per ideal combination. Leave two lines gap, effective borrowing rate. Now here there is no link between M and S. M will not pay anything to S. S will not pay anything to M. I will sit in between. I will collect something from you, pay something to you, collect something from you, pay something to you, and in the end I will earn 0.1%. I will earn 0.1%. What is the ideal combination rate for both the companies? 8% and T plus 1.2, and effective is T plus 0.35, 8.95. T plus 0.35, 8.95. Clear? Now here very simple. Borrow from bank as per ideal combination. Whatever you pay to bank, receive from the intermediary. Whatever you pay for both the companies. Both the company receive from intermediary. What will you pay to the intermediary? Your effective borrowing rate. Your effective borrowing rate. What we are doing is we borrowed from the bank, cancelled that loan, and the new loan will be at the effective borrowing rate. So receive from intermediary, in bracket, what was paid to bank. Receive from intermediary, what was paid to bank. Now it will get cancelled. For both, it is the same thing. There, it used to be balancing figure and all, because first you will do and then write accordingly. Here, no. Intermediary means receive whatever was paid to bank and pay our effective BR to intermediary, which is this number. Copy paste. Pay our effective borrowing rate to intermediary. Clear? With this, structuring gets over. One more simple explanation or an important point. This, if you understand, okay. If you don't understand, also it's okay. If you see here, the intermediary is doing t plus 0.35 is equal to 8. What do you get as t here? T plus 0.35 is equal to 8. What is t? Participate, guys. 7.65. This way, you do t plus 1.2 is equal to 8.95. What is t? In one place, you are swapping t as 7.65. Another place, you are swapping t as 7.75. Intermediary will make that balance 0.1. Intermediary will make the balance 0.1%. In one place, he is swapping at 7.65. Another place, he is swapping at 7.75. So, what banks normally will quote us, they'll say our the our IRS rate is 7.65 slash 7.75. This is how banks will normally quote 7.65 slash 7.75. What does this mean? If you have to pay me something, you have to pay 7.75. But if I have to pay you, I'll pay effectively 7.65. I will effectively pay 7 point. If you have to pay me 7 point. You are paying here 7.75, and here I am paying fixed. I am paying indirectly the fixed. So I do swapping as 7.65 and 7.75. 7.65 and 7.75. I earn 0.1%. I earn 0.1%. Any doubts on this? Now write this alone. Effective T for M limited and S limited. This is not needed from exam point of view. This is just for your understanding. Effective T 7.65, 7.75. 7.65 and 7.75. T plus 0.35 equal to 8, T equal to 7.65, T plus 1 point is equal to 8.95, T is equal to 7.75. Clear? Any doubts on this? The intermediary net will earn 0.1%. The intermediary net will earn 0.1%. Any doubts on this? Clear? So with this, the IRS discussion, one question I've done. There are a lot of other questions to do, but concept is very simple. What IRS does is, it helps me in converting a fixed loan to a floating loan, or a floating loan to a fixed loan. IRS is possible if, let's assume, there is fixed combination, IRS not possible. Floating combination, IRS not possible. I want fixed, other guy want floating, and it is ideal, then also IRS not possible. I want fixed, other guy want floating, and it is matching the ideal combination, IRS not possible. I want floating, other guy want fixed, and it is not matching, then only IRS is possible. Clear? Any doubts on this? We'll continue in the next session.